managing directors of commercial banks, colleague directors of the Central Bank of the Gambia, the media. I now read the press statement on the decision of the Monetary Policy Committee. The Monetary Policy Committee of the Central Bank of the Gambia met on the 20th and 21st of May 2026. After assessing domestic and global economic conditions and the near-term outlook, the committee decided to maintain the monetary policy rate, MPR, at 14%. The following is an overview of deliberations that informed the committee's decision. Global economic activity is expected to moderate in 2026 amid rising geopolitical tensions, renewed inflationary pressures, and persistent policy uncertainty. In its April 2026 World Economic Outlook report, the International Monetary Fund, IMF, projects global growth at 3.1% in 2026, a 0.2 percentage point downward revision compared to January 2026 forecast. The weaker outlook reflects the adverse impact of geopolitical tensions, elevated energy prices, and increased uncertainty on global trade, investment, and financial conditions. Growth prospects continue to vary across regions, with advanced economies projected to expand by 1.8%, while emerging market and developing economies are expected to grow by 3.9% in 2026. Growth in sub-Saharan Africa is forecast to slightly moderate from 4.5% in 2025 to 4.3% in 2026 due to the impact of the ongoing war in the Middle East, tighter fiscal space, and currency depreciations in some economies. Global inflation is expected to rise temporarily, driven by higher energy and transport costs associated with the ongoing war and trade disruptions. The IMF projects global headline inflation at 4.4% in 2026, representing an upward revision by 0.6 percentage points from January 2026 estimates, before moderating to 3.7% in 2027. Inflation dynamics, however, continue to diverge significantly across economies, with commodity importing developing countries remaining particularly vulnerable to imported inflationary pressures arising from elevated global commodity prices and exchange rate volatility. International commodity prices remain broadly elevated amid renewed geopolitical tensions and supply disruptions linked to the conflict in the Middle East. The International Monetary Fund, IMF All Commodity Price Index, increased by 28.1% in April 2026 relative to January 2026, reflecting the sharp rise in global oil prices from $60 per barrel in January 2026 to $100 per barrel in April 2026. The increase largely mirrors heightened geopolitical uncertainty and disruptions to maritime transport and global supply routes. On the domestic front, the Gambian economy continued to demonstrate strong resilience despite increasing global uncertainties and adverse geopolitical developments. Economic activity remained robust in 2025 and is expected to maintain strong momentum in 2026, supported by sustained growth in tourism, construction, trade, and financial services. The central bank composite index of economic activity points to a positive start in 2026, with activity averaging at 3.5% in the first quarter, in the first 3 months of the year. Against this backdrop, the central bank in its latest forecast around projects real GDP growth at 5.7% in 2026, representing a 0.5 percentage points downward revision. This revision is precipitated by the adverse impact of escalating geopolitical tensions in the Middle East, which contributed to higher domestic energy prices, elevated inflationary pressures, and increased uncertainty in the global economic environment. The Central Bank Business Sentiment Survey for the first quarter of 2026 indicates continued positive optimism among firms, supported by festive demand, peak tourism season, and strong performance in the construction and digital financial services sectors. Despite the positive business outlook, inflation and exchange rate expectations remain elevated, while concerns over geopolitical spillovers and election-related uncertainty continue to weigh on confidence in the domestic economic outlook. Preliminary balance of payment estimates indicate a weakened external position in the first quarter of 2026, amid rising import demand and elevated global uncertainties surrounding commodity prices and trade conditions. Consequently, the current account deficit widened to 20.83 United States dollars, 20.83 million United States dollars, 0.8% of GDP in the first quarter of 2026, compared to 13.19 US dollars or 0.5% of GDP in the corresponding period of 2025. The deterioration in the current account mirrors higher imports of printing-related materials, mineral fuels, and oil, cereals, and vehicles, despite continued improvements in tourism receipts and stronger remittance inflows. The goods account deficit widened to 284.37 million US dollars, or 11.2% of GDP in the first quarter of 2026, from 248.07 million US dollars, or 10.2% of GDP in the corresponding period of 2025. The deterioration in the goods account deficit largely reflects a 20.6% increase in total imports, which rose to 424.65 million US dollars, or 16.7% of GDP in the first quarter of 2026. Although exports rose to 140.28 million US dollars during the same period, supported by stronger re-export activity, they continue to linger well below the rising imports. Domestic foreign exchange market remained stable in the first quarter of 2026, recording an increase in transaction volumes. Aggregate foreign currency purchases and sales amounted to $644.19 million US dollars compared to $590.8 million US dollars in the first quarter of 2025. In addition, total remittance inflows from January to March 2026 amounted to $246.08 million US dollars, an increase of 17.2% compared to the same period in 2025. The improved foreign currency liquidity conditions partly reflect steady private remittance inflows, a rebound in re-export trade, and gradual recovery in the tourism sector. The dollar remained broadly stable during the first quarter of 2026, recording marginal appreciation against the US dollar and the British pound by 0.3% and 0.5% respectively, while depreciating modestly against the euro by 1.2%, 3.5% against the Swiss franc, and 0.6% against the CFA franc. The central bank continues to maintain adequate international reserves to provide a strong buffer against external shocks and exchange rate pressures. As at end April 2026, gross international reserves stood at $556.5 million US dollars, equivalent to 4.3 months of prospective imports. Preliminary estimates of government fiscal operations in the first quarter of 2026 indicate an improvement in the fiscal position relative to 2025. The overall deficit, including grants, narrowed to $2.3 billion or 1.2% of GDP, compared to $2.7 billion or 1.4% of GDP in the same period in 2025. Similarly, overall deficit, excluding grants, improved to $5.0 billion or 2.5% of GDP in the first quarter of 2026 from $5.5 billion or 2.8% of GDP in the corresponding quarter of 2025. This positive trend reflects stronger domestic revenue mobilization, supported by ongoing improvements in tax administration and fiscal consolidation efforts. Government domestic debt stock increased to $53.3 billion or 24.0% of GDP at end March 2026 from $51.99 billion or 23.4% of GDP in the corresponding period in 2025. The composition of domestic debt remained concentrated in the short-term instruments, accounting for 54.8% of the portfolio. Money market rates remain relatively stable between January and March 2026, although generally higher than in the corresponding period of 2025, reflecting tighter liquidity conditions in the financial system and sustained government borrowing requirements. In March 2026, the interbank weighted average rate and the 91-day Treasury bill yield increased to stand at 6.3% and 6.2% respectively, compared to 5.7% and 6.0% in March 2025. Annual money supply growth accelerated to 23.2% in March 2026 from 11.3% in the same period a year earlier, reflecting increased contribution from domestic credit conditions. Credit to the private sector continues to expand, recording a growth of 35.4% in the first quarter of 2026 compared to the previous year. Similarly, reserve money grew by 17.2%, a reversal from the 0.9% contraction recorded in the same period last year. This expansion mainly reflects the increased holdings of foreign assets as foreign currency inflows strengthened during the period. The banking sector remains stable and resilient, supported by strong balance sheet growth and sustained depositor confidence. The industry assets increased to $129.9 billion or 67.6% of GDP in the first quarter of 2026, from $104.8 billion or 52.6% of GDP a year earlier. Total customer deposits, the main source of funding for banks, increased by 20% to $84.2 billion or 43.2% of GDP in the first quarter of 2026. Capital adequacy ratio of the industry marginally declined by 4.0% to 24.3% in the first quarter of 2026, relative to the same period in 2025. The decline is attributable to an expansion in risk-weighted assets, driven by an increase in loans and advances. The liquidity ratio of the industry stood at 78.3%, well above the 30% regulatory floor. The non-performing loans stood at 7.7% in March 2026, down from 8.1% in December 2025, and 13.5% in the corresponding period of 2025. Fintech and mobile money services continue to expand in scale and usage, reflecting sustained growth in digital financial services. Cash-in transactions increased by 11.7% to $27.0 billion, and cash out grew by 15.2% to $30.5 billion between December 2025 and March 2026. The number of registered users stood at 5.4 million, up from 4.7 million in September 2025. Domestic inflationary pressures have shown signs of reversal in recent months, reflecting the impact of the rising global energy prices, transport costs, and renewed external price pressures. Headline inflation increased to 7.0% in April 2026 from 6.6% in December 2025 and 6.4% in January 2026. The recent uptick in inflation partly reflects higher food and non-food prices amid amplified geopolitical tensions and elevated import costs. Food inflation rose moderately to 6.7% in April 2026 from 6.2% in January 2026, reflecting increases in the prices of meat, fish, fruits, and nuts. Meanwhile, non-food inflation accelerated to 7.2% from 6.4% over the same period, reflecting rising prices of transport, housing, and utilities, as well as selected services-related categories. Further assessment indicates that underlying inflationary pressures have also strengthened. Core inflation, which strips out volatile energy prices, increased to 6.6% in April 2026 from 3.4% in January 2026. Similarly, core 2 inflation, which further excludes volatile food prices, rose to 6.5% from 4.6% over the same period, suggesting domestic inflationary pressures are becoming more broad-based and renewed upside risk to inflation outlook. The Monetary Policy Committee observed as follows. The global economy continued to demonstrate resilience despite renewed downside risk arising from heightened geopolitical tensions and disruptions in the global energy markets. Latest projections indicate that global growth will remain above 3.0% in 2026 and 2027, supported by fiscal stimulus measures, easing financial conditions, and resilient private sector activity. Nonetheless, rising geopolitical uncertainty and elevated energy prices continue to pose risk to global output, investment, and inflation dynamics. The committee noted that developments in the global economy will continue to have important spillover effects on the Gambian economy, particularly through tourism, remittance inflows, commodity prices, and trade activities. Global inflation momentum has weakened in recent months following renewed increases in energy transport costs associated with the conflict in the Middle East. Global headline inflation is expected to rise temporarily in 2026, reflecting elevated oil prices, supply disruptions, and increased shipping costs. Although international food prices remain relatively contained, the committee noted that commodity importing developing economies, including the Gambia, remain vulnerable to imported inflation through higher fuel, transport, and exchange rate pass-through effects. Consequently, risks to the domestic inflation outlook have tilted to the upside. On the domestic front, the Gambian economy continues to demonstrate resilience amid heightened external uncertainties and rising global inflationary pressures. Economic activity remains robust, supported by strong remittance inflows, recovery in tourism, construction activity, and continued expansion in digital financial services.